From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. We are looking at markets very much on the move to the upside after a weaker than expected PPI report. We'll walk you through that. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
We begin with the big issue, markets testing the Fed.
The volatility has been huge.
The market is a little optimistic.
It's not surprising that we're seeing a bit of a rally here.
Market participants are ping-ponging back and forth based on one data point.
Congratulations. We had record high inflation. We just didn't add to it.
We had better oil prices. I mean, that's essentially what the CPI tells us.
How sustainable is this sort of perception of the policy pivot from the Fed really going to be?
It's probably more of a head fake from these levels.
There's still a lot of work for the Fed to do.
The Fed is still going to hike in September.
We've heard those exact words from a number of committee members.
It wasn't just the hawks on the Fed coming out yesterday. It was the Kashkaris of the world.
When you get a market like this
overreaction.
They need to push back hard on this market.
The Fed is still on full watch.
So do you buy the rally or do you fade the optimism? Joining us now, PJM's Robert Tipp and Anthony Saglimbembetti of Ameriprise. Sorry, Saglimbembetti. I apologize for that. I want to start, though, with this question, Anthony, with you, how much you can really buy into the rally that people are getting from this conviction the Fed will not have to raise rates as quickly as they thought before.
Yeah, I think you highlighted it right. I mean, we've had developments over the last couple of days that suggest that maybe the environment is getting a little bit better, CPI coming down, PPI coming down, but inflation is still very, very high. And so I agree with the kind of the more bearish sentiment is that there's a lot of work for the Federal Reserve to continue to raise interest rates. And so I think the market might be getting a little ahead of itself. 1 month does not make a trend, but we've seen 10 straight months of headline inflation coming in at or above expectations. So the July print yesterday for CPI is good news for the market, and stocks are rallying on that. I think you still have to be a little bit cautious and be a little bit more defensive in terms of kind of moving through the rest of the year, because we need to see more months of inflation coming down. But the Fed is very likely to raise interest rates through the rest of this year.
Robert, did the CPI print yesterday and then the PPI print today change your view on how you look at the market, how you look at the Fed's response function?
Sure. Yeah, I think that the good news in yesterday's report is that there was some movement in inflation. I mean, the more you see just searing hot inflation, along with the really strong job growth, the more fears grow that the Fed is going to have to move incredibly aggressively to stamp this out. And almost more important than that, that they will lose patience. I think that the market understands that this process of reopening has to play out, of supply chain disruptions has to play out, and it will play out. But it's going to take maybe 5 years to get things back in equilibrium. And the most important thing in that interim period, I believe, is that the Fed not panic, that they guide this slowly, and getting a CPI number that was a little bit more in line with some of the PCE numbers that we had seen over the last handful of months, I think it's a big relief for the markets.
So today, is it a greater chance, in your view, Robert, that we are going to see a soft landing than, say, 4 days ago?
On the margin, yes. This is hotly debated, but I think that actually we're going to have something. The potential is there for something better than a soft landing. I mean, if you think about it, a lot of industries are operating at low levels at this point. Airlines, that's not entirely recovered. International travel is not fully back. Business travel is not fully back. Autos are at recessionary levels. Now housing is back at 2019 levels. There's a lot of potential for growth, and people feel pretty good, and they are willing to spend what they earn. We need more supply. So I think actually looking 5-10 years out, the problems that we're having on energy, the high level of prices, high level of profitability, this is going to beget more supply. And this could actually turn out, I think there's a chance that this could turn out a lot better than people fear.
In the meantime, a lot of people are saying it all comes down to the labor market. That's the view from Renmac's Neil Dutta, writing the following. Wage growth is running red hot, and absent a turnaround in productivity, this will ultimately fuel higher prices. Anthony, how optimistic can you get when you see this sort of increase in wage pressure, especially given that we still are seeing a lot of people not coming back into the jobs market?
Yeah. So I think wage inflation does have to moderate, and I think that's what the Fed is looking at. And particularly on the demand side, consumers don't really change their spending habits if they believe there's security in their job. And so I think for mid to higher income earners, I don't think the demand environment has changed much because of this inflation. And so if they feel confident that they can either get more in terms of pay or there's job security, they're likely to continue to spend. And I agree with the assessment that supply chains will normalize over time. That's actually what we've seen in some of the.
I think we're having some technical difficulties. We're going to work them out. But as Anthony was saying, that we are seeing some supply chain issues start to work their way through the system. And you are seeing falling prices, not only with CPI, but also producer prices. U.S. producer prices falling for the first time in more than 2 years following a slowdown in inflation. This coming as Fed officials pour cold water over hopes for a dovish pivot.
The idea that we are going to start cutting rates early next year when inflation is very likely going to be well in excess of our target, I just think it's not realistic. I think a much more likely scenario is we will raise rates to some point, and then we will sit there until we get convinced that inflation is well on its way back down to 2% before I would think about easing back on interest rates.
For more, let's bring in Bloomberg's Michael McKee, who's with us right now. Mike, I've been really surprised at how many Fed officials have come out and said, the market's got it wrong. We're committed to this. We have a lot more work to do. And the market's saying, we don't buy it. You guys are wrong. You're not seeing the disinflation that we are. Who's right?
Well, whatever happened to the old idea of don't fight the Fed? And another question, if one swallow does not a summer make, do 3 swallows make a soft landing? Because now we've had unemployment fall to a 50-year low, we'll call it, and the first drop in PPI now since April of 2020 when the economy got smacked by the pandemic. So we are seeing, at least in 1 month, a lessening of inflation pressures. These are at the headline level, so a lot of it is energy, as you guys were saying, but it is still a drop. What the Fed is considering, 50 or 75 basis points, still open to debate for September. But they're all making it pretty clear that that is not where they are going to stop. Mary Daly talking to the Financial Times. Inflation remains far too high, not near our price stability goal. We're not near done yet. And Charlie Evans saying he expects they'll be increasing rates the rest of this year and into next year. You heard what Neil Kashkari had to say. Keep raising rates. And what they're going to do is get to neutral or a little bit above. Kashkari says it should be 4.4%. Charlie Evans says 3.5%. I did 3.5% roughly just to make the point here that the market is pricing. They'll get to that point and immediately start cutting rates. The Fed is saying, no, we're just going to keep rates at that level until we're convinced that inflation is going down. Now, who's right, Lisa? If the economy is going into recession, then the market is probably going to be right. But if the economy holds up and the labor market numbers suggest it is at the moment, then the Fed is going to be following through and the market's going to have to adjust.
Mike, thank you so much. And a big part of this is just what happens with how quickly inflation comes down and the impact on companies. Principal Seema Shah looking for the next leg lower, writing, quote, as we get into the fourth quarter earnings, growth will show clear signs of struggles and inflation will be easing only slowly, giving markets an important reminder that further height rates are absolutely necessary. That should lay the groundwork for renewed market declines. Still with us, Robert Tipp and Anthony Saglan-Benny. Anthony, from your perspective, do you still see downside here on the equity space because of just this dynamic that the Fed is going to push back, that the decline in inflation is going to be too slow, and that companies are going to feel the brunt?
Yeah, I think the market is pricing in the scenario where maybe by the end of the year, early next year, the Fed can pause. and maybe even cut rates down the line in 2023. I think if inflation pressures remain sticky, I think the markets are going to react a little bit more negatively to this concept that even if we get to some terminal rate, say around 4% for Fed fund futures or Fed funds rate, we likely may have to stay there to bring inflation down. And I think the markets have they're looking past that and really suggesting that we'll see the Fed cut next year. And I don't know if that's the case. At 8.5% headline CPI, the Fed has a lot of work to do. And the markets are going to have to come to grips with that at some point.
And meanwhile, Robert, we're seeing in the bond space a real reversal in terms of the yield curve inversion. Basically, people bidding down the yields in two-year treasuries, bidding up the price, and doing that more so than on the long end, than on the 10-year. Do you think that this is the correct trend, that you're going to see a re-steepening in places in the yield curve as people expect the Fed to start perhaps backing off, even if it isn't that much?
Yeah, I think we will see a little bit of that. I mean, I think to Neil Kashkari's point, they're likely to raise rates. They're likely to need to stay there, and they're going to be waiting. But I think, what we're looking at in some respects is a growthless expansion. We've seen jobless expansions in the past, but you look at the last couple quarters, there's no growth. People are concerned about wages going up nominally, but wages are not keeping up with CPI. So this is not a self-sustaining wage price spiral. There is real wage erosion. And in a way, we need time here for the supply to catch up. And over that time period of seeing the Fed funds rate get to 3 or so, these long rates could be under a little bit of pressure to go up, a little bit of re-steepening of the curve. I think that's correct.
Robert, how frustrating is it that so much of this conversation is being dictated by the price of gasoline?
Well, I think that's not uncommon. And there's an illusion of control that Volcker solved the last inflation problem. But when you look back, you see that energy prices cured themselves in some respect. We had the OPEC price shocks, but ultimately the cure for high commodity prices and inflation in some respect are the high prices. And energy prices came down through 85. Wages went up in more structurally rigid economies like the US back in the 70s. And those jobs that price themselves out were purged in the 80s. So I think there's a matter of time here. It's not necessarily all about the Fed, but we're going to see these high rates while the Fed waits for things to come back in balance. And I think we are seeing that process happen, but it's going to take a long time. And yes, a little bit of steepening.
Robert Tipp, Anthony Saglin-Benny, both of you are sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell, here's Abigail Doolittle.
Well, Lisa, we do have the S&P 500 E-mini futures at May highs, a really impressive rally that we are seeing here that you all are talking about. Helping out today, not surprisingly, Disney. The stock is surging. This after Disney Plus subscribers came in at 14.4 million subscribers for the quarter, better than estimated for the third straight quarter. And even so, they are pulling what they can do so well, which is to raise prices by 38% to boost revenue. And it's not just the streaming service that's doing so well. Disney World admission up more than 3,800%. Occidental Petroleum also higher, up 2.1%. Oil is well above $90 per barrel. Plus, Warren Buffett's Berkshire Hathaway buying more shares, now owning more than 20% of the company. Some thought that this is the beginning of perhaps buying out the company. We don't know that, of course, but that has been some conjecture. To the downside, though, Sanofi and Glaxo actually fall for a second day as the antacid Zantac shows a possible cancer link. And then Six Flags, well, Lisa, not all theme parks, entertainment parks are created the same. Their admissions actually declined by 1.4%, merchandise down by 8%, and sponsorships and hotels by 33%. So Disney doing very well. Six Flags, not so much.
Abigail, thank you so much. Coming up, President Biden taking a victory lap amid cooler inflation.
Our economy had 0% inflation in the month of July. 0%. We're seeing some signs that inflation may be beginning to moderate.
That conversation still ahead as we see the markets rallying on the heels, not only of that CPI print that came in a little bit cooler than expected, but also the PPI print that we got just about 45 minutes ago. This is Bloomberg.
Our economy had 0% inflation in the month of July. 0%. We're seeing a stronger labor market where jobs are booming and Americans are working, and we're seeing some signs that inflation may be beginning to moderate. It's far from done in our effort to bring inflation down, but we're moving in the right direction.
President Biden touting his economic plan amid softer inflation. This coming as Americans continue to feel the price pain. Rental costs soaring to a record high. Food prices surging the most since 1979. Bloomberg's Emily Wilkins joining us now from Washington, D.C. Emily, there is a tricky moment for this Washington, D.C. right now because they have done what they can in terms of releasing money, releasing oil from the strategic petroleum reserves. Do they have anything left to do to fight inflation in the near term?
Well, Democrats would say that what they are doing to fight inflation at this point is trying to find other ways to lower costs, lowering the cost of prescription drugs, getting more funding into renewable energy, lowering those costs, funding semiconductor production, hoping to lower the cost of certain things like tech and autos. But Lisa, of course, the reality here is that, just because the government passes a funding bill doesn't mean that suddenly Americans wake up the next day to lower prices. And so I think that you are going to see politicians really try to tout what they have done. But the fact remains that inflation is still high. Several months ago, Treasury Secretary Janet Yellen said that she expects it to remain high into next year. That certainly includes this November when lawmakers are looking at their own reelections. And the things that really hit a lot of Americans here, yes, gas prices are now below $4 for the first time since March, but the cost of food is going up. The cost of things at the grocery store are going up, and rental prices are going up. And all of those are going to hit a lot of Americans.
Emily Wilkins, thank you so much for being with us. The team over at Citi parsing through the CPI numbers and warning, quote, "We would caution the details of the report still point to very strong underlying inflation. Weakness was very concentrated in components like used car, hotel prices, and airfares, while shelter prices and general services remain very strong." Still with us, Robert Tipp and Anthony Saglim-Benny. Anthony, I want to get your take on this sort of two-tier economy. And we've been talking about it throughout the morning, how you're seeing the discretionary spending of lower income families really get hit. Is that informing your views in terms of which companies you prefer going into and how you are arranging some of your investments?
Yeah, great question. I think for lower income earners, obviously the higher gas and food prices is sucking more of their discretionary spending into those staple items. I think for mid to higher income earners, we're continuing to see demand in services, travel, leisure, and that's kind of what you've seen in some of the data. I think moving forward, as demand normalizes and we move further away from the pandemic, if food prices and energy prices remain high, I think it may start to change the behaviors of more consumers, and that's more damaging to the economy because middle and higher income earners drive more of the growth in the U.S. economy. So if we do see energy prices stay at higher levels and food prices stay at higher levels, then I think that's a concern. But we have a very strong labor market. And as I said earlier, as long as consumers feel confident that they're working and that their job is secure, then I think we can kind of move through this period of normalization without a big material drop in spending. So some of the cyclical growth.
Seems like we're still having some issues with Anthony's connection here. Robert, from your perspective, how do you sort of parse through the differentials in the economy, whether or not the weakness that we see in certain tiers of income will broaden out to a greater number of the population versus the optimism that we're seeing in some of these cooling reports?
Right. Well, I think, in some respects, we've gotten through the easier part of the recovery. The jobs lost have been recovered. The rate of growth has been very high in jobs up until this point. And at some points, the real GDP growth was very high. But now we're at a point that, as you're highlighting, at your lower income strata, the increase in prices at the pump, at the supermarket, those are really very damaging. And also for people that are looking at the high end to go into services, to go fly and this kind of thing, prices are up, but service is down. In other words, you get to the airport and they cancel your flight, you have these delays. You're at a more painful part of the economic recovery. And I think, the good news is that the job market is very strong. and that the Fed is moving pretty cautiously, and the next 75 basis points of rate hikes, 100 basis points is priced in. And I think their job owning right now is in an effort to keep the markets from easing and having rates come down. But this is a much more awkward part than what we've been in.
So how much conviction do you have, Robert, to take some of the risks, to go into high yield bonds, to go into duration, to really double down on some of the things that have been working for the past month?
Sure. I think that, we're in an environment now like we have not seen for decades. We have been in an environment where inflation was low and stable, and there was, if anything, kind of a feeling of excess supply in the economy. Central banks were trying to get inflation up to target. This is totally different. Incredibly strong job market, not enough supply of goods and services, very high inflation. So this is a dangerous environment to really bet heavily on a change in rates from here. Having said that, 5 or 10 years from now, looking back, this is definitely going to be the highest growth in inflation that you're going to see, probably for the next 40 years. So I don't think rates are going to go a lot higher and stay there, but there is some aggressive two-way movement risk here. So I think being tactical on the curve, the steepener, but I think that there is a place on the spread side. I think you can't be super aggressive, but I think there are a lot of really good values out there on the credit side, even at this point.
Robert Tipp, Anthony Seiglen-Benny, thank you both so much for being with us. Coming up, the morning calls, and later, Mandy Zhu of Credit Suisse staying away from risk assets as markets diverge on recession risk. Mandy will be joining us at the opening bell. From New York, this is Bloomberg. About 4 minutes to the opening bell. We are seeing that rally extend on the heels of the softer than expected PPI data. Time now for the morning calls. First up, upgrading First Solar to overweight, a $145 price target, expecting the company to be the biggest beneficiary of the Inflation Reduction Act. Next up, Citi downgrading Lowe's to neutral, citing slowing demand for home improvement and tighter budgets. And finally, Guggenheim raising Disney to buy, seeing tremendous parks momentum and confident streaming price hikes. Coming up, Credit Suisse fading the rally. We'll get the view from Mandy Zhu at the opening bell. This is Bloomberg. Countdown to the open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of trading, and you are seeing that rally continue to extend gains. The Nasdaq 100 as well as the S&P both up about 0.75%. This, of course, came on the heels of a weaker than expected PPI data point. This comes following the CPI. You see that with the bonds bid into them and the yields lower both in the front end and the long end. And dollar weakness. How much is this going to be the theme as we get risk on, meaning dollar selling off? Joining us now with a look at the stocks moving at the opening bell, here's Abigail Doolittle. Abby.
Hey, Lisa. Well, let's take a look at some of the movers behind this rally. A two-day rally, the S&P 500 at its highest level since early May. And, of course, Disney is surging up about 9% on the morning after they not only beat revenue and earnings estimates, but the big deal is Disney Plus subscribers coming in above estimate for a third quarter in a row, 14.4 million subscribers. They've also upped prices by 38%. And it's not just the stay-at-home piece that's doing well. It's also the reopening trade. The resort revenues rose sixfold to $2.2 billion. Amazon, one of the rally's big winners, up about 38% since its June 16th low. Well, it keeps going, and a piece of why that Nasdaq 100 closed out of a bear market yesterday. And in a bear market, Schlumberger higher with a broad rally in oil back above $90 per barrel. And of course, the IEA talking about demand growth. And then finally, Macy's on that better than expected CPI number yesterday and the cooler than expected, better than expected, I should say, PPI number today. Department stores in general rallying on the idea that perhaps consumers are going to have extra discretionary money to spend on clothing and other goods at these retail stores. Lisa.
Abigail, thank you so much. Tech, meanwhile, reclaiming nearly $2.8 trillion in the market cap. The Nasdaq 100 rallying 20% from its June lows. Taylor Riggs is here with more. Taylor.
And this is what makes markets, right? It's all about the way we look at it. So yes, there has been sort of a 20% rebound off of the big lows around mid-June. So that maybe would signify on a technical basis a new bull market. We're out of the bear market, except you're still about 20% down from some of the recent highs that we've had. So that sort of puts it into some of the long-term perspective. But here we'll focus on sort of the short term, the big rebound that we've had off of the mid lows in June. I think what's interesting is when this happens, historically, things have been pretty good in the year after. You gain an additional 23% historically when you sort of come out of these big bear markets and push higher. Big tech gains, though, in terms of real money turns, Lisa, it is not just sort of these headline indices, but underneath the surface, it has been Apple, Amazon, Microsoft, Tesla. Big tech has been the big rallying that you've had in the last month or so. In terms of market cap, huge numbers. We're adding trillions of dollars off of about those June 16 lows.
Just amazing to see such big cap companies move so quickly and violently in one direction or another. Taylor Riggs, thank you so much. Investors growing more skeptical over whether the latest rally can last. BTIG weighing in and writing, quote, "We've been cautious all year. Clearing June's high on a closing basis would go a long way to suggesting the trend was shifting." Bloomberg's Kaylee Lyons joining us now with more. Kaylee.
Well, Lisa, I like what Taylor did there with giving the rally context. So what I will say is while we've seen $5 trillion in equity value and the S&P 500 recovered since the lows of June, we have to keep in mind that the index is still down about 11% on the year. So context is important. What's interesting, though, is that what has led the rally are the same groups that led the decline in the first half. Growth stocks, for example, up about 12% over the last month. A Goldman Sachs basket of non-profitable tech companies up more than 20%. And even the small cap Russell 2000 is higher by about 15% in just a couple of weeks. So to see if that's going to last, now we go to the chart watchers who are on alert. Technical analysts over at Bank of America, for example, saying that the Russell 2000 is showing a similar bottoming out pattern relative to the S&P 500 we last saw in 2020. And for the S&P, there was a lot of optimism around that 4177 level, the high of that May-June rally. So maybe the charts are sending more positive signals and this is becoming a less hated rally. But the fact is investors weren't positioned for it. And frankly, they still aren't. Professional investors are still the most short since 2016, Lisa.
Thank you so much. Kaylee Lyons. Mandy Zhu of Credit Suisse is fading this rally despite some of the optimism we've heard just recently. She writes the following, quote, "Equities and credit markets are pricing in soft landing. While rates and commodities see recession as increasingly likely, our view remains that it will take a recession to bring inflation back down to target." Mandy Zhu, I am so pleased to say, is with us now. And Mandy, I know this is sort of an awkward moment because the market's going in the other direction. Do you double down on that conviction? Or do you say, you know what, maybe there is something changing here about how far the Fed has to go?
So I do think there's a big debate going on in terms of how far the Fed has to go. I think there's consensus that we've seen peak inflation. But the question is, OK, now what, right? What does that mean for Fed policy going forward? And I think in the equity market and in the credit market, maybe have gotten a little bit ahead of themselves in terms of pricing in a soft landing, right? So the view that the Fed is able to tame inflation with relatively few economic, damages, right? And that's why you're seeing, equities rally, I think right now about 10% off the highs, and a rally led by large cap tech. That is a market that is, telling you that we're going to a soft landing. But what concerns me is if you look into the rates market, into the commodities market, there's definitely disagreement. The yield curve has become further and further inverted over recent weeks, even as we've gotten this risk-on rally. That's a market that's telling you we're going to recession.
Okay, this is a really important point, and it's something that people have been talking about. Is the decline that we've seen in oil prices a symptom? Or is it the cause, right? And is it a symptom of weakness in the overarching economy? Or is it the cause of the inflation? And when it rolls over, everything's going to be copacetic, right?
Right.
So which do you see?
So I think the weakening in commodity prices is a symptom of the weakening global growth that we do see currently. And the tricky part here is that if the Fed backs off or is perceived to back off, right, investors are going to write down recession risk, and that's going to actually boost commodity prices and down the line boost headline inflation, right? And that's why taming inflation is so difficult. And that's why, if you look in the 70s, right, the Fed, by backing off too early, actually let inflation run hot for over a decade. I think they're very much, do not want to make the same mistake again.
So how much do you actually get conviction in this opposition to the rally? Because the Fed is going to have to job on this down for fear of getting into another 1970s-like inflationary kind of cycle.
Exactly. I think core inflation is going to be very difficult to bring down to target because a bulk of it is housing, it's shelter inflation, it's service inflation, and without significant weakness in the labor market, it's really hard to see core inflation really returning to target. And then when it comes to conviction, what's really notable is on this rally, it's not a high conviction rally at all, at least from institutional investors, right? So what we've seen certainly in the derivatives market, which is typically where you look for the first signs of upside chasing, we're not really seeing meaningful call buying. If anything, in recent days, we've seen a pickup in hedging, either people adding new protection or resetting hedges. So I think, that conviction is missing right now from institutional investors.
But isn't that a bullish sign?
Yeah, well, people have been making that argument for a while. I do think, what this suggests is that, we haven't reached the max pain point, right, for that consensus short position, meaning that, people have not covered their shorts, right, that we potentially could see more upside in the near term. But overall, in the longer term, I think the broader GDP inflation trends is going to dominate, and our view is still pretty cautious there.
So if we haven't reached the pain point and you're recommending in some capacity shorting this rally, right? How do you do it without sort of absorbing as much pain as the pain point would suggest?
Yeah, so there are good structures that you can look at in this environment. So one trade that we really like is overwriting your core exposure. So sell calls on top of the core holdings that you currently have. And essentially what this trade does is that, it's positioning for limited upside from here. But if you do get called away, right, you collect a pretty juicy premium for that option that you're selling. And what we observed is, at least at the single stock level, volatility is still very high, right? The VIX has normalized sub 20. Index volatility has come in a lot, but single stock volatility on average is still trading, very elevated. We're still seeing big moves at the single stock level, and that's why, by overwriting, you're still getting a pretty good premium for that.
Speaking of which, what do you make of Reddit getting back into the trend here? I mean, this is one thing. I was looking at AMC and I was looking at Bed Bath & Beyond, and I'm thinking, why are these rallying so much? And people said, well, it's a Reddit chain,
So that's a big debate. How much of this rally that we're seeing right now is retail driven versus institutional driven, right? And I can just, I see the institutional flow, and I can tell you institutional players like hedge fund positioning, if you look at it, net exposures have actually been coming down on the rally. People are not buying into the rally, and certainly in derivatives, we're not seeing that upside chasing.
Of course, some retail investors will say that they actually were correct, while a lot of institutions were wrong. So perhaps it's a question of where the smart money is. Mandy, what are you looking for to determine whether you should change your view and perhaps get a little bit more constructive on the outlook and buy into it or shed some of the shorts?
Sure. So for me, what I'm looking at is core inflation decelerating very, very strongly. It's now our economist's view. It's not my view. But if in the coming month, we see housing market starting to really crack, we're seeing, labor market really starting to crack, then I do think that gives Fed the room to really start to pivot. Without that, I think the Fed's going to continue to at least, if not hike 75 basis points, but continue to hike, 50 basis points, 25 basis points.
So, Mandy, another aspect of this rally has really been big tech, right, as you mentioned, and they've been moving around really substantially, massive kinds of market cap swings. And I'm looking at Apple and I'm looking at some of these other companies that hinge on the sales of smart devices, on personal electronics. And then I see the likes of NVIDIA, of Qualcomm, of Micron, all giving out pretty negative forecasts for their chip sales, particularly with respect to this area. What gives? How do you sort of bring these two stories together and make sense of them in a constructive way for big tech?
I think, a lot of the bullish thesis with big tech is the fact that they're able to generate strong earnings, in a slowing economic growth environment. That's something that, semis, for example, is not as immune to. And as we've seen in the past, earnings cycle, big tech has able to, did beat expectations a lot of times for earnings. So I think that's part of it.
So then why is the discretionary spending also rallying in tandem with big tech that would do really well if they had really big cash flows?
I think this is an environment where we're seeing a lot of debate in terms of the strength of consumer and just how strong, and obviously what we're seeing in the consumer space is a divergence between high income, low income. So in discretionary, even in discretionary, you're seeing a big divergence there based on kind of the strength of kind of what is the consumer base, right?
So what are you looking for in order to double down on the bearish position? I mean, this is something that I know Mike Wilson of Morgan Stanley has talked a lot about, expecting margin pressures heading into the second half of in the fourth quarter. And yet part of the argument was that potentially producer prices would increase at a faster pace than CPI, than consumer prices, and that would shrink margins. But what we just saw raises some questions about whether that's actually the case.
Yeah.
Where are you in this question?
So I think for me, I'm looking at consumer spending and labor market strength and whether or not we really see, because we've got a very strong payrolls data recently, and that has boosted the case for a soft landing. For me to really, double down on the bearish thesis, I need to see weakness in consumer spending and payrolls going forward, and that's what I'm really watching.
Before we let you go, and we really appreciate you being here today, there is an issue that you raised about a Fed put and whether it's the other direction, whether we have a Fed call. And how much do you rely on the Fed jawboning the market until they listen? And if they don't listen, then raising rates more than they expect in order to get the market to behave and stop easing financial conditions at a time where they need to bring inflation down. How much is that what gives you the ultimate conviction?
Yeah, so there's certainly this conundrum, and I raised it with commodity prices, right? And that as the Fed is perceived to be more dovish, right, growth expectations increase, and that's when you have equities higher, commodities higher, and that kind of feeds into the overall inflation narrative. So that's definitely part of the reason why I do think the Fed is going to have to be a little bit more hawkish in order to really rein in inflation. And I think watching the loosening of financial conditions in recent weeks is probably not it's not what they want to see.
Yeah, certainly they have been saying that this is not what they want to see, and people are saying, well, it's what we're doing anyway. Mandy Xu, you're sticking with us. Coming up, the International Energy Agency boosting its forecast for global oil demand.
There's a lot of uncertainty on the demand side, so this is also something that the OPEC is factoring in.
OPEC telling a different story. That conversation still ahead as we see stocks rallying even further in the first 15 minutes, led by big tech once again as you see a $2.8 trillion market cap add-on to that sector. This is Bloomberg.
There's a lot of uncertainty on the demand side, so this is also something that the OPEC is factoring in. They're worried about spare capacity that is dwindling now. It's basically only Saudi Arabia and the UAE that is holding any substantial amount of spare capacity. As the IEA has stressed, we still have a lot of emergency stocks in our member countries.
Two energy outlooks, two very different views. The IEA raising its demand outlook for oil just this morning. OPEC just this morning cutting its own, seeing global markets tipping into surplus this quarter. OPEC writing in its latest report, quote, global oil market fundamentals continued their strong recovery to pre-COVID-19 levels for most of the first half of 2022, albeit signs of slowing growth in the world economy and oil demand have emerged. Joining us now is our very own Julian Lee. Julian, what do you make of this? And I have to say, markets weighed in. They buy the EIA. They do not buy what OPEC is selling because prices did not come down on that report. Yeah. What's your view on why such a massive dispersion here?
Well, I think a lot of this is actually to do with history. I mean, a good part of the upward revision that the IEA made actually goes back to revisions that they're making to 2020 demand figures that are then rolled through. And added to that, the IEA made it very clear that it sees underlying demand growth weakening. It pointed to a couple of what it called, I think, extraordinary factors. One is switching out of gas into oil, particularly in Europe, because the shortage of gas in Europe is even worse than the shortage of oil. And the second thing is with very, very high temperatures in the Middle East, we're getting a lot more oil burning for power generation there. That's quite usual at this time of year, but I think they're perhaps seeing even more than they have in the past. One thing I would note is I've been looking at the IEA's year-on-year demand growth figures, and they're demand growth now for the fourth quarter of this year is only back where it was in March. So yes, they've increased their demand forecasts, but that comes after several months in which they've been cutting those forecasts, and they're still forecasting a lot less demand growth this year than they were back at the start in January.
Julian Lee, thank you so much. It's clear as mud right now what's going on with oil, and it's such a major component of CPI and PPI that it's causing a lot of people headaches, including Mandy Zhu of Credit Suisse, who is still back with us. Mandy, I want to start there. How do you gauge out where oil is going to be, and how essential is that to your view?
Sure. So I would say there's been actually a change in terms of investor positioning and view on oil and commodities in general. So to start the year and for probably the first quarter or so, first half of the year, commodity was such a consensus long in a lot of people's portfolios. That was the highest conviction long, of all the investors that we talked to. And at the time, all the focus was on the supply risk, right, with Russia, Ukraine, and disruption to the commodity supply chain. And what we were highlighting at the time was, there's also demand risk. And since then, obviously, oil has corrected, commodities have corrected. So right now, I think the risk is more evenly balanced between supply and demand. And for me, the outlook is going to come down to, a lot of it is going to come down to China, right? Because a lot of the view, bullish thesis on China, on oil comes down to China reopening, and China's biggest consumer of commodities globally. So our view, and we've held this view for a while now, is that China is not going to abandon its zero COVID policy anytime soon, certainly not this year, and as a result remain a source of actually downside risk to demand in terms of commodities.
Well, the short group's seeing weaker oil demand driving prices lower, to your point, Mandy. Take a listen.
Demand destruction right now is the key driver to lower oil prices. When we look at demand relative to seasonal norms, we're looking at demand destruction that's nearly 200,000 barrels a day, 2% below normal. So clearly, as the saying goes, high prices are the cure for high prices. So Americans are balking at these prices, and they are driving less.
Mandy Zhu is still with us. Mandy, what's your view in terms of how much more we see demand destruction given the rapid decline that we've seen in gasoline prices, and that we're now seeing prices that look more in line with historical averages?
Yeah, I think in the U.S., gas prices have been coming down for a couple of weeks now, and what we're seeing in the latest data in terms of summer driving and demand is the demand really hasn't rebounded to the same degree as the decline in prices, right? So to me, at least in the U.S., that demand may be a bit slow to come back. And then if you look outside the U.S., right, Europe is, I think, almost certainly going to a recession this year. China is going to be very slow to reopen its economy. So again, on the demand side, I think the risks are still tilted to the downside, and that's why, if you look at in the derivatives market for oil, at least, skew is still fairly elevated, meaning they're still pricing more downside risk to the commodity rather than upside. A few months ago, it was actually the other way around, people positioning for further upside in oil. Now it's much more looking at the downside, and because of this demand.
And this is even as you do have OPEC nations representing a tightness, an inability to produce all that much more. What's the risk that there could be some sort of pivot? What's the fragility of markets right now to oil prices unexpectedly spiking?
Absolutely. I do think, if we do get a significant supply disruption, the spare capacity, right, is very, very minimal. So that upside risk is certainly there. It's just that it's also balanced because of the weakening, the global growth story. So that, it could have happened, yes. Is it kind of my base case? No.
Just before we let you go, how thin is trading right now, just broadly across asset classes?
I think liquidity is challenging, and part of the reason why you're seeing increased intraday volatility is because of that thin liquidity, right? The same size trade is just going to have a bigger market impact, and that's something that we're certainly tracking.
Mandy Zhu, thank you so much for taking the time. Great to catch up with you. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In markets, you are seeing that rally on the heels of perhaps thinking the Fed does not have to go as far as fast. That NASDAQ leading the gains with Amazon up 0.6%, and Meta surging 1.6%. This is Bloomberg. 25 minutes minutes into the trading day, and you have a confirmation of what we saw yesterday in terms of the rally, extending gains with the S&P up 0.7%, same as the NASDAQ. What you could see is that bid into bonds. Perhaps the Fed does not have to hike rates as quickly, and that is what you're seeing in the two-year yield, sharply lower at 3.1%. Time now for the trading diary, what you need to be watching this week and next. San Francisco Fed President Mary Daly speaking tonight, Bloomberg Television at 7:30 Eastern. We'll get the University of Michigan Sentiment Survey on Friday. Looking ahead to next week, we get July housing starts on Tuesday, retail sales key, and Fed minutes coming on Wednesday, plus existing home sales and another round of jobless claims on Thursday. From New York, this was Countdown to the Open. This is Bloomberg.